But the point you made about rural is very, very important, and it's very close to the Mahindra Group, and you know that. So I call that the B2B movement, not just back to basics, but back to Bharat movement. I'm going to take advantage of Ananta still here. He had an engagement, but he's staying on for a few minutes more. Navneet, I'll just take advantage of his presence for a few more minutes, and then I'll come back to you. Ananta, this thing about global low inflation phase and global capital flow seeking that extra return, that is contributing to a lot of risk appetite because the interest costs are so low, inflation levels remain low, therefore investor what they put as cost is low. So anything looks better than that, and emerging markets certainly look better. And therefore, you're seeing this capital surge. What could stop this surge? What could stop this flow of capital across countries?
So, I think, in fact, one could even argue that the flow of capital across countries, especially looking for better returns into emerging markets, might actually continue unless emerging markets themselves want to actively impede that in the coming years. Because I do see a situation where developed country returns will become scarce in real terms. You brought up this idea of low inflation, low nominal returns, and therefore developed country investors seeking returns elsewhere. So what is going to happen is low nominal returns will now be accompanied by low real returns as far as inflation comes back. Inflation will come back in the developed world only when the labor class begins to assert its rights. And I feel 40 years of labor class being muzzled in the developed world is, whether we like it or not, is going to end and come back, especially if there is a change of guard at the White House. So with that, what will happen is the developed world will face more problems with respect to generating returns. You may have a situation of the replay of the 1970s when both bonds and stocks in real terms did not yield much at all for dollar-based investors. So in that sense, the opportunities will remain in the developing world, especially those who have the ability, as Navneet pointed out eloquently in his remarks, those who can embrace reforms and those who can do the right things. So in that sense, we could actually see that as an opportunity.
So now let me bring that back to Navneet. Navneet, you pointed out to Deepak, and my own company has used this opportunity to shore up capital. There are obviously there are some headline stories of my neighbor actually, who has raised a lot of capital quite recently, and significant sums of capital. Now, from a CFO standpoint, this is something that is anathema to a CFO to sit on this kind of excess capital, right? Which hurts all your issues. But from a risk management standpoint, this is kind of the right thing to do. How is the market kind of factoring this? That companies will sit on excess capital for a foreseeable future.
So, the world we are in, and given the known unknowns and the unknown unknowns, is better to have more capital, more liquidity, and I would say that's true for like even your supply chain. We're in a world where we have been trying to optimize everything. The just-in-time management, or the perfect capital structure, or the minimum amount of liquidity, because keeping cash is a crime for a CFO, so on and so forth in the world we are in. But the kind of uncertainty that lies ahead, and I think the true test of risk manager lies ahead. You aren't seen nothing yet, and I think in one of the article Ananta mentioned the next 10 years. I think brace for a very, very bumpy ride. So it's better to be over prepared than under prepared. And I'm sure the classical debate, in fact, with Deepak, when he was raising money, and we had this, obviously, I mean, in a financial firm, it's ROA into ROE, and I mean the leverage, And if your leverage is going to be lower, you remain overcapitalized, I mean, definitely it's going to impact ROE for the shareholders. But I think on the other side of the crisis, the opportunity is so big that I think in next few years, if you can just survive and I think focus on that, it's better to do that rather than keep trying to optimize, which the world has been trying to do for the last 20 years. Deepak wants to say something.
Okay, you go ahead and ask the question, Vaidhi. Yeah. No, I just wanted to answer Navneet on his point about being comfortable with capital and liquidity. I think raising capital has two issues. Yeah, one is you want to protect what you have because you are getting into an uncertain future, so you don't know how the future will really pan out. And of course, what Navneet alluded to, when you have so much uncertainty, yeah, mortality is bound to happen. Yeah. There is bound to be mortality. There is bound to be trouble, and any mortality, yeah, in any sector always results in significant opportunity for some people. And when you look at opportunity, you'd better be stocked up on capital rather than start running around for capital when opportunities strike. That's my 2 bits. Sorry.
No,
Money is always available when you don't need it.
No, but if you heard what Deepak said, there is there's an old adage I grew up with when I came into capital markets, which was buy when there is blood on the streets, and it actually the sheer auger of it put me off. But when I look at smart players who moved around, right, who have kind of converted every challenge into an opportunity, I think I tend to agree with Deepak that there is going to be a skewedness that you will see. The 2008 banking crisis actually resulted in greater concentration with fewer banks, right? So one of the things, and you need to be prepared for it. You need to, JP Morgan's kind of tank size treasury chest really helped them through that period when they could take in a lot of acquisition, and those paid over the years in terms of consolidating their position. Deepak, before I come to you, I just have one more question for Navneet, because Navneet effectively is the person that every CFO of every listed company is trying to please. So we want to make sure that in our risk management focus, we understand his expectations right. Mota, there is the P&L, which determines my earnings, which has been hit for the last 3 or 4 years because the nominal rate in the economy has been down, right? So earlier, companies' revenue would grow by 15% year on year just because of inflation of 8%, 9%. Now that inflation is down, the revenue growth is not happening, and therefore the absolute numbers from my P&L are low. My cash flow was anyway under stress because of a lot of macro changes that happened, and it has now gotten into a bigger stress. My balance sheet, till 2008, we never looked at balance sheet. 2008 told me look at balance sheet, but it told me to look at the asset side of the balance sheet, and all of us focused on the asset side, don't have bum investment. Now it's telling me liability side of the balance sheet, how well are you funded on yourself as opposed to borrowing. So you have these three-legged stool that the CFO is facing. How do we please you? Because you never tell us what you want. What are you looking at? What is it that gives you comfort on a company?
I think that the resilience, who has the resilience, and I think that's very, very important. I think as I mentioned earlier, a fortified balance sheet, I think a liquidity position which can sail you through regardless of how how much this position can deteriorate over the next 12 or 18 months. Nobody really has any idea. I mean, Ananta talked about, we don't know whether it's a V-shaped, it's a W-shaped, it's a U-shaped or L-shaped, or that, you know, the inverse of that square root, or I've heard I, which can only fall. But it could be other way around also, you don't know. So it's better to be over prepared than under prepared. And I think it's very, very critical. And also I think the innovation, the one thing that I strongly believe is that business is going to change fundamentally. And you see the last 10, 15 years, I mean, we can argue about the Tesla's valuation, but I mean, definitely Tesla did not come out from any of the traditional auto company. Airbnb did not come out of a traditional hospitality company, or that's true of Uber, that's true of Amazon, that's true of Netflix. The world is changing very fast. There are so many of these disruptions and these trends are only going to get accentuated. And in this world, for companies, I think spending money on innovation, spending money on R&D, if somebody cuts today in terms of cost cutting, every cost has to be reimagined. But if somebody comes and tells me that I've cut down my R&D by half because times are bad and I want to preserve my money, I'll be really negative on that company, because innovation is something that will sail you through. How are you looking at, one, how do you survive this crisis, but how are you preparing yourself to take advantage of the opportunities on the other side of the crisis? In India, we have a long way to go. We are at $2,000 per capita, poorest of the poor country in the world, with 1.35 billion people, the biggest labor pool supply for the world for next 50 years. And if I think the way I'm just repeating that, I mean, the future of education, the future of healthcare, the future of, I mean, the financial services, future of like almost all businesses is going to be dramatically different than what we have seen in last 50 or 100 years. So to me, I think, how do you build that resilience, your risk management, or how do you take care of your people? You'll have to completely reskill them and think about people very, very differently today. I mean, I can give you several examples, but in the interest of time, I'll just leave it there. But I think all of those are very, very critical, and that's what we look at. I think these qualitative factors are equally important than the quantitative factors. What has worked in your favor in last 10 years may not be. In fact, I have a very strong view when people ask me about large cap versus mid cap versus small cap, and I said it has nothing to do with the size of the assets that you have today. It's your nimbleness, it's your agility, it's your ability to adapt to the environment. And I think taking that from the Darwin, that I mean, it is the most adaptable who survive, it's not the largest who survive. And you will see some of the biggest guys turning into dinosaur in next 10 years as the world is changing.
Wonderful, Navneet. Wonderful.